Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the wildcards that could affect the 2025 housing market. We have a lot to discuss, but before we dive in, I wanted to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, and I'm glad that we all have firmer bottoms, too.
Oh my gosh. We did not anticipate that was going to attract the kind of attention it did. Although when we were doing the episode, I kept going, is it just me? I just have I was about to crack up in my
I'm completely oblivious. I was just talking economics.
I know you were. Well, we have a pretty important topic today, which is what are the wildcard economic factors or other factors out there that could really affect the 2025 housing market? So from your perspective, what's number one there?
So again, we have 2 years worth of data now and market reaction toward data. And whenever the economic data gets weaker, bond yields fall, mortgage rates get better. But even with the weakness that we've seen in some of the economic data lines, we've never been able to really crack under 6%. And this is why, this is my forecast range too, kind of 7.25 to 5.75 the last 2 years. Of course, we went all the way to 8% in 2023. The spreads were worse back then, right? But now the spreads are much better, even with a 10-year yield picking up a few 21 basis points recently. The better spreads have kept things in check. But what if the wild card sends mortgage rates below 5.75? I've even said it. My entire housing forecast goes out the door if that's the case. So because we track live data weekly, we could adjust to anything that's happening current. We don't sit there and say the same things over and over and over and over again at the end of the year and go, oh, well, this didn't happen. So the question is, what is the wild card for 2025?
What is the wild card? Okay, from your perspective, what is it? Obviously, the nature of a wild card is you can't always see it coming. You
can't, but this one, it's getting close into the area. I actually do believe that the Fed addresses housing next year, not for the existing home sales market, but again, economic cycles kind of all mirror the same things. And we've always highlighted this. The fifth recession red flag on my recession red flag model, that went off on August or in June of 2022. Housing permits were falling, starts were falling. There's still a backlog to work, but all that stuff means that the builders are going to start laying off people soon. And it actually did occur. Single family workers actually did get laid off. But then mortgage rates fell November 9th. Everything changed. The economic cycle changed, home prices, all that stuff changed. And things got better for the builders. But now we're in a different state. Now the labor market is slowing down, not breaking, but slowing down. Any kind of triggers into the labor market, any kind of shocks to the system can get you to that next stage where you'd be losing jobs. So now it's a little bit different for the builders because the completed units for sale, even though it's not very high, it's not a high level compared to the total homes out there in America. But for the builders, permits and starts are at recession levels. They're working through their backlog already. Once that is done, there isn't much work there, and this wasn't going to be an issue this year because the backlog still had to be worked through. But we're getting to the point to where you're playing with fire and you don't really need to, because just 1% lower in rates changes a lot of things. But it also impacts the future production of housing, which if you wanted to fight inflation, if you're worried about rent, that's where you really want to go. So the wild card, oddly enough, can be negative for the new home sales market, but positive for the existing home sales market, which wasn't the case the last 2 years. The new home sales market has completely outperformed the existing home sales market by a wide margin. And the existing home sales market is still trending at the lowest levels of sales ever, adjusting to the workforce. So you can get a situation to where if that data line starts to break and we start to lose residential construction and mortgage rates and the 10-year yield starts to fall, and then the Fed feels, okay, we're really behind the curve. And, President-elect Trump's going to go, oh, look what you guys did. And, that can be a wild card because it's not going to be part of my forecast until I see the frontline data gets negative. But if that occurs, then housing outperforms, in that step. The existing home sales outperforms. And eventually rates go low enough and the builders can sell more homes. That's a wild card that could possibly happen in 2025, which, wasn't really the case in 2023 and 2024. But because inventory is up, because active inventory is up, completed units of sales are up, it's harder to sell homes in the South now. So you're going to get less production of housing in that area compared to others. So we have this wild card here. We could see it. We just got to be able to see that frontline data, because when that happens, everything in housing changes, because that means you can stay below 6%, for a little bit more duration. And we've seen what the market does when mortgage rates just get towards 6%. But sub 6%, the builders have shown you can grow sales. They're at 2019 levels, near COVID levels, so they're able to still sell homes. It's when rates got to 6.75 and 7.5 that there was issues early on in the year. So it's a wild card because it would change how I perceive what housing can do in 2025.
So I always appreciate when you put out, when you do your analysis of the new home sales, right? And the construction numbers and all that. And what you're looking at is like how much of the months of supply that they have is under construction versus the part that's not even under construction yet. When you're looking at like, are we taking up all the backlog? How do you measure that? How do you know when we're getting through the backlog?
Homes under construction starts to fall down, which it has, then you can see the backlog is being worked through. This is really happening with the apartment sector, where it takes 21 months. So we're just finishing apartments that started almost 2 years ago. So that, the apartments under construction or permits, all those things are falling down noticeably. So we're working through this. It should be completely done in terms of the excessive backlogs in the apartment sector. So the new home sales sector still has about 100,000 homes that haven't even started yet. That might not sound like a lot, but that's like record high levels for that. So it's one of these meticulous little, it's frustrated so many of the recession people because they just naturally assume, people would get laid off by now. Again, Sarah, these are what these people are rooting for every day. This is their whole life. It's just, I'm telling you, these guys are getting older and older, and it doesn't get prettier for them. That their entire lives are doom porn. In any case, this is something where you can make a valid case. It's not a housing. A lot of people take the completed units for sale. Like, oh my God, there are more homes here than 2000. No, think of it on the economic side, because that is something I always said. I can't get under 5.75 until the labor market breaks or spreads get better, or the Fed actually says we want to have kind of a pro-housing policy because we don't want to see production go down any lower than what it is. Something like that. That could be a wild card because if you notice, the Fed says nothing about housing except for Neil Kush. Oh my God, people are buying homes. Like, how are we supposed to balance a mortgage? Stuff like that. It's not very useful.
So from your perspective, let's talk about what happens first if there is, in fact, this is one of the wild cards. So are you saying that the first thing that happens is that we will lose construction jobs and the Fed will be like, oh, we need to cut rates because, it will have already been falling? Or do you think the Fed cuts rates and then it has that effect?
The Fed, take rate cuts out of this equation. What's going to happen is that the new home sales data starts to get weaker. You're going to start to see permits even fall more, starts fall more, and then the 10-year yield starts to get a little bit of whiff of that, and the bond market will always get ahead of the Fed. When you start to see we've lost about 109,000 manufacturing jobs recently. manufacturing and residential constructors together tend to be kind of the boom and busts of economic cycles. That's why you see their jobs get lost before every recession. So once you start seeing jobs reports where you saw construction labor being lost, and then the builder surveys will start to say, hey, listen, guess what? Rates are just too high. We have too much supply. We have to, you'll see that happen first before the Fed ever does anything. But in that regard, the 10-year yield will start to go lower ahead of that. And this is something that we haven't had to deal with. In 2022, we had this really sharp decline in new home sales and sharp decline in permits and starts. It looks like every recession except we had this backlog. New home sales weren't really elevated. And when rates fell, builders' profit margins, they were able to, now you see these builder stocks getting downgraded to sell ratings. They haven't done so good lately. Supply is picking up. Margins are getting compressed, right? That's not the environment that we've had to deal with in the last 2 years. But now it starts to be. So this is something that, we keep an eye on. We always want to, look out for what pitfalls. But this pitfall in itself can be a positive for the existing home sales market because we've all seen this. We just get down to 6%. But if you get sub 6% mortgage rates, and I will pound the fist on this, or pound the table on this, we are always going to be getting higher home sales than what people can estimate if that occurs, because that's what the builders have shown us.
That's good. Okay, so that is a potential wild card. What's the next potential wild card that you're looking at?
Well, the other wild card can be, what if global weakness really starts to pick up? And, I was showing this chart on Instagram today. We have, everyone says that the U.S. it's all this inflation is the U.S. No, it's the entire world. Where I took about 11 countries and showed their inflation rates, and oh my God, all their inflation rates are coming up and all their inflation rates are coming down. Everything works the same. But what if you have more global weakness? Remember back in November, or excuse me, it was October of 2022, we wrote, what's the case for lower mortgage rates? Well, back then the dollar was super strong. The world, London was going to lose its pension funds, all this market stress. And then the next move was lower. Global economic weakness. Now, what President Trump's tariff trade talks or whatever, it can cause chaos for other countries, that are more reliant on selling and exporting than we are. Right? We're so much of a domestic economy. That, if it could create more world drama, bond yields can fall. Right? Remember, global bond yields tend to somewhat move together. I know China's, a lot lower right now, but they've been in a recession, or they've had economic troubles for some time. But if you get a more of a global issue, then that could be something that could push yields lower and, in a sense, beneficial for the new home sales market and the existing home sales market together in that regard.
That is super interesting to think about. And I love that all of these things that we're talking about are things that you track on a regular basis. You write articles, analysis for us on these different things. So people just have to either be reading your stuff or listening to this, and we will see it and we will talk about it.
Yes, I track economic cycles first. Housing is secondary, even though most people know me for housing, because, again, everything to me revolves around the 10-year yield, right? Whatever's going around the economic cycle, how it is. And hopefully now, showing people that when economic data got better, bond yields went up. When economic data was getting worse, bond yields went down. We just kind of move off of that. That's why when I went on CNBC like 2 years ago, I said that the entire housing market revolves around the 10-year yield. So how that goes, and look what's happened. Demand picks up when the 10-year yield goes down. Demand gets weaker when the 10-year yield goes up. We don't have underwater mortgages in scale, Sarah, that article that we wrote on Friday.
That's right. No, that's a great article. So before we get off wildcards, I wanted to propose one. So from my perspective, so 2 years ago, was it 2 years ago now, we had the banking crisis with Silicon Valley Bank. Was that in 2022 or 2023?
2023.
2023. Okay. So coming up on 2 years this spring, but One of the things that we're tracking in the newsroom is Donald Trump's his team, his advanced team, kind of talking about like what they can do with different bank regulators. So of course, Elon Musk famously said, we need to delete the CFPB. I don't even know if that's possible. But this week, some of the big news was that the advanced teams are talking about for, when they're looking at like who's going to lead the OCC, FDIC, like, hey, what if we consolidate these? What if we get rid of some of these? What if we do this? And so from your perspective, well, from my perspective, bank regulations or just chaos in that sort of like what's happening with that, could that be a wild card for the housing market?
No.
Just easy no. Okay,
No,
why? Tell me why.
First of all, that's going to take some time because you just can't get rid of an agency without having something, not to replace it, but some kind of part of the ecosystem to take care of the transactional things that they were doing. So for 2025, no. Assume a hypothetical, they get rid of the FDIC, which is like, why y'all picking on them? All they do is insure people.
Right. I mean, of all things, I'm like, FDIC, don't we all want a strong FDIC to be in place?
We also kind of have to remember the FDIC is, in a sense, is like a piggy bank. What the real power players are the Treasury and the Fed, right? So those things in the United States government, like we can put out fires if we want to. Like what happened with Silicon Valley Bank? Well, look what happened there. There was like, okay, here comes the over a weekend. Powell and Yellen took care of it. So whoever the Treasury, and it's going to be Powell until he leaves, they can wipe out some fires if they wanted to. If you're talking about going out in the future, regulations, and then can credit flow better? But when credit flows better, is the economy going to be at more risk? That's something down the line, not necessarily a 2025, I would say, wild card. But there's just, there could be crazy headlines, of which I just naturally is going to soon be the case for the next 4 months. But I don't see that as being, on the economic side, nothing material until you actually get something done. And then what replaces it, or what's the transition, or are they all going into one kind of a umbrella entity, something like that nature? On the economic side, nothing worthwhile of that to change anything. You need to change rules first and get it written stones before things could ever operate in any kind of fashion. And cross that bridge when we get there. But for now, it's not on my wild card list.
Okay, good to know. We will keep an eye. One of the things about bringing in outsiders, so Trump is pretty well known for he's bringing in some people who maybe, it's not like, oh, they were the deputy chief of this place before, is that they may overestimate how much they can do in a short amount of time, because you do have this giant machinery that runs, and it's hard to get rid of it. Even if you're bringing in people at the top, like there's a whole thing going on in the background, and especially with regulations that around money.
Yeah, politicians, to me, they talk a lot, they promise a lot. If they can deliver, that's a whole different thing. That's why I'm always like, I need to see something change first, and I'm not going to put any energy into what hypothetical. Because you imagine trying to work models off economics on what presidential people say or do, especially the last 12 to 16 years. No, it's crazy. Just always remember the U.S. economy itself is very dynamic and structural. It's got advantages that other countries don't have, and we can wipe out fires very fast if we wanted to.
If you want to. Okay. Any other wild cards that you're looking at right now for the 2025 housing market?
Those are it for me. Really, the housing market is the one, because completed units of sales are rising, active inventory is rising. The South is weaker than other parts. Job growth is slowing down. There's a recipe there that we can look at it and see it, and we just have to really focus on the frontline data. A lot of people today, the yield curve inversion has steepened up, and people go, well, every recession, by the time this occurs, it happens. And I always try to tell people, be careful what you think the bond market is telling you without labor triggers happening first, right? So we've had it's the end of 2024. A lot of people were saying the U.S. went into recession in 2022. Somebody said the U.S. went into the recession in October of 2023. You can't double or triple or quadruple down on a bad call. That's why you really have to focus on the frontline data, and then you need to see authentic weakness before you want to bring your recession theories. But we could kind of connect the dots on this in 2025, and then what is it? Paper, rock, scissors, labor over inflation, right? And I get it. It's a lot of people just thought, well, if the growth rate of inflation falls and labor, mortgage rates, yeah, they didn't. They're still elevated, and it makes sense to me. But you really do need economic weakness and the labor market getting softer to get that next stage that a lot of people are looking for. So this is just the wild card that I could see right now, and I could connect the dots with all the charts and everything.
Okay, so let's talk about, so we are talking on Friday, right? This is going to be dropped on Monday, but talking on Friday, you're looking at delinquencies, you're looking at, you're writing an article, but I haven't seen it yet. So tell me what we're going to be talking about here.
Oh, we're talking about the underwater mortgages.
Underwater mortgages,
yeah,
okay.
so it is 1.8%. It's up 0.1% from the last quarter. And one of the things I highlighted is that, we always think about, in 2010, 23% plus of homes were underwater. And, we had all those new listings data, which, this is why I always like to show that it was so different back then. But those new listings were coming into an underwater market. Quarter of the marketplace was underwater. So foreclosure risk. However, one of the things that I've, when I tour the country, people ask me, well, mortgage rates went lower during 2008 or 10 and housing demand didn't pick up. Yeah, well, the credit markets were broken and we had a lot of people underwater selling equity, right? That is a lockdown more than the mortgage rate lockdown you talk about, Sarah. The underwater mortgages are actually authentically locked down because you literally have to either bring money to the closing or there's just literally no way you can sell your house and buy another one. So back then, the whole system of housing, that little relationship of families between sellers and buyers, first-time home buyers, the whole thing was broken. Absolutely. That was just smashed. So now we don't have that. We just need lower mortgage rates. Why? Because there's so much nested equity. 40% of homes don't even have a mortgage, and the loan to value rate are at the all-time lows recently for those that do have mortgage. So there's a lot of equity, and also the average down payment nationally is 15% now for back-to-back years. So we do have that, not only just cushion for foreclosures, but also, boy, people can just sell their homes and buy another one more freely now than back then. And that never gets discussed enough. I'm always surprised how a lot of people just don't remember that and how that was a big issue. But now, not only do you not get the foreclosure hit on your credit, you actually can sell your home. And not even if you have financial difficulties, you can sell your house, or you can sell to buy another one more freely now than what we were dealing with back then. So that just means that the sale potential is actually real, where back then you have to model out, well, these people can't sell their homes because they're underwater by X amount and they'd have to bring money in. Most likely they're not going to do that. So I think that's a positive story also going into 2025, because we've had another year of home prices rising and another year of nested equity being built. I think what is the number? It's like $180 trillion. The Fed funds or the net wealth of America. That data came out this week. So just remember, when everybody says Americans are poor, they've got 15 or $20 trillion in consumer debt. And I go, I got 180 trillion behind me. I'm the richest. I'm the richest person in this whole planet. What do you have? I got $160 trillion surplus. How's your piggy bank look? So
why do you, when you look at all that nested equity, we haven't seen, people really tapping into that to the extent that people had thought that they would, right? So to you, does that underscore the fact that they're doing really well? They don't have to do that. They don't have to tap into that.
So it's interesting. I did an interview with NPR. The census data just came out with the mover rate. That's the percentage of people moving. It's at the lowest levels ever. This has been happening for a very long time. There's many variables that go into this discussion. A lot of people say, well, we're an older society. Older people don't move as much. That's true. Okay, so that impacts the data line. You can make the case that there's a lot more dual household incomes now than ever, right? So if you're moving, a lot of times you're going to have to move where both people get a job, not just one person. So that prevents people from moving. I've looked at it in this way where, 1975, the median square foot size home being built was 1,500. It got up to 2,700 in 2014. It's been slowly going down lower and lower to provide, cheaper housing. But in this regard, our family sizes are getting smaller and smaller as well as our homes. So the product we're giving to the American public that are buying anything new is big enough for a family of four. So housing tenure has doubled, like from 1985 to 2007, it's 5 to 7 years now. It's 11 to 13 years, 15 to 18 in some parts. I always say I've lived in my home for 20 years. In this regard, there's a lot of nested equity. It's just I don't think people move as much as they used to. And when you're doing really good, when you have a very low payment, moving in itself, and what I talked about with NPR, I think the Fed said it's like an average of $5,000 increase, for people that move. And it's shocking at first, but when you have a very, very low mortgage payment that you've had for a very long time, and then all of a sudden now you got to buy a bigger home with a higher mortgage rate, so the payment explodes up higher. So
you mean what some would call a mortgage lock-in effect?
No, that's not a mortgage rate lockdown.
Yes, you did.
Property taxes, insurance, everything. You're buying the whole tamale. The amount of what you're borrowing, Sarah Wheeler. That's what nobody talks about. You could have an 8% mortgage rate if you're borrowing $80,000. It's not that much, but if you're borrowing $800,000, even at 6 or 5%, it's a lot. So this has been going on for some time. So I kind of chimed in, and I just, we don't move as much. And now work from home created the facilitation of moving to cheaper areas. And, especially, people in California could benefit from that. But it's not shocking to me. This has been in a downtrend for a long time. My concern is always that when the labor market gets softer and people start losing their jobs, the cost of housing, where can I find work? Where can I move to? Though it becomes a more problematic issue now that shelter costs are so high when the labor market is getting softer, and it's getting softer in the sense it's harder to find work for people. The unemployment benefits for those that are higher than 10 days, it's growing. We're not at recession levels, but it's growing. So you see the labor market getting softer, but if it gets weaker, the lack of mobility does become a problem for the U.S. economy, where it isn't much of an issue right now.
So interesting. We have so many things to watch as we come up on the new year. I'm looking forward to in the new year in February 26th, we're going to have our Housing Economic Summit. You're going to be our keynote. Mike Simonson's going to be there. Every great economist on the planet, if they were able to make it work, is going to be there. And we're really excited about the Housing Economics Summit on February 26th. So I would say everybody mark your calendars there. It's here in Dallas. And we will talk to you again soon, Logan.
Pleasure, Sarah.
Thanks.